What if I told you that insurance companies don't actually make most of their money from your premiums? And that the entire industry is built on a strategy most Americans never think about. But pay for every single month? While your rates keep rising, stay with me. Because the truth is bigger than you think. Hi, I'm Emily. I'm a finance expert who explains insurance and money in the simplest way possible so families can protect themselves. Today we're breaking down something that affects every American with a car, a home, or a family to protect. How insurance companies really make money. And what it means for your wallet. Let's start with the biggest illusion. That insurance companies make their money from premiums. Most people think it works like this. You pay them, they hope you never file a claim, and they pocket the difference. And yes, that's part of it. But here's the twist. In many years, especially recently, they actually lose money on premiums alone. Let me explain. In the US, particularly with auto and home insurance, companies are facing a storm of rising costs. And on top of that, medical costs for liability cases and large jury verdicts, what the industry calls social inflation, are skyrocketing. In fact, many major insurers reported underwriting losses in 2023 and 2024. That means they paid out more money in claims and expenses than they collected in premiums. So if they're not profiting from your monthly payments, how are they still billion-dollar giants? This brings us to the real engine of the insurance industry, something called the float. Here's the secret sauce for how big players, like State Farm, Progressive, and Geico truly get rich. In that time, the company holds your money. And trust me, they don't just let it sit in a checking account. They invest it. This massive pool of money, collected from millions of customers before it needs to be paid out, is the float. It gets invested in everything from government bonds and blue-chip stocks to real estate and corporate debt. Some of the largest insurers even dip into private equity. The legendary investor Warren Buffett built a huge part of his empire, Berkshire Hathaway, by specifically buying insurance companies. Why? Because they generate a massive, continuous stream of float money that he could invest at virtually no cost. The real profit isn't in your premium. It is in their ability to invest billions of dollars of your money before they ever have to pay a dime back to you in claims. It's like getting an interest-free loan from millions of customers. Day after day, year after year. That's the real power behind the industry. But float isn't the only tool in their shed. Insurance companies also master a complex math game built on underwriting discipline and managing claim behavior. It all starts with data. They analyze millions of data points to predict your risk, your zip code, your age, the model of your car, your driving record, even your credit score. In most states, everything goes into a giant algorithm. If their model flags you as a high risk, you pay a higher premium. If you're a low risk, you pay less, but they still get to profit from investing your float money. An adjuster needs to visit, you need repair estimates. There might be more documentation required, and if another party is involved, there's a liability investigation. The longer this process takes, the longer they hold on to your money, and the longer that money stays invested and earning returns for them. And then there's the part that frustrates people the most, denying or minimizing claims. This is a real, documented practice. A famous court investigation from years ago revealed that some major auto insurers used a deny, delay, defend strategy to cut costs, and quiet versions of this playbook still exist today. Insurers raise rates across the board because accidents in your entire zip code increased. Or because the overall cost of car parts and medical care rose. Or because a recent natural disaster changed their risk calculations for your whole region. You didn't do anything wrong, but your cost still goes up to protect their profit margins and their underwriting results. Now, not all insurance products are created equal. Some are absolute cash cows for the industry. Life insurance is a huge one. Life insurers collect your premiums for decades, investing that money and earning massive returns over a long period. For most customers, the company holds on to that cash for a very, very long time before any claim is ever made. Another one is extended warranties. Whether it's for your car or a new TV, these plans have incredibly high profit margins, often over 50%. The likelihood of you using it is low, and the cost of repair is usually far less than the price of the warranty. specialized commercial insurance, like cyber liability or business interruption policies, are also highly profitable. They command high premiums, but the frequency of claims is relatively low. Roadside assistance, rental reimbursement, accidental death riders, special coverage for your jewelry. They seem like small, helpful additions, but they add up to big profits for the insurer. Insurance isn't just a business transaction, it's a promise. It's something we rely on during the absolute worst moments of our lives: a house fire, a serious car accident, a sudden medical emergency, or the death of a loved one. And yet, the entire system is designed to maximize profit, minimize payouts, and when possible, delay compensation. You place your trust in them, but their business model is fundamentally built on controlled risk and strategic investment, not just on protection. This inherent conflict is why so many Americans feel betrayed or angry when a claim gets denied or is difficult to process. It feels personal, but it's not. It's the business model in action. But here's the good news. Once you understand how insurance companies actually profit, you can start playing the game smarter too. You can take back control. First, shop around for insurance every 6 to 12 months. In the U.S. insurance market, loyalty rarely saves you money. New customers often get the best pricing to win their business. Second, consider increasing your deductible. Raising your deductible from, say, $500 to $1,000 can dramatically lower your monthly premiums. You're taking on a little more risk yourself, but the savings can be substantial. Third, always ask for discounts. Most companies have a long list of them, and many are hidden unless you ask. There are discounts for being a safe driver, a good student, bundling multiple policies, driving low mileage, having anti-theft devices, or even just for signing up for paperless billing. Fourth, check your credit score. In most states, a poor credit score can increase your auto insurance premium by 50% or even 100%. Improving your credit can directly lower your insurance costs. Fifth, don't buy every single add-on they offer you. Roadside assistance, rental coverage, glass protection. Sometimes they're worth it, but often they're not. Evaluate if you truly need them, or if you are just paying for peace of mind you will never use. And a huge one for life insurance. For most people, the best option is to buy term insurance, not whole life, not universal life. Just simple, affordable term life insurance. It gives you high coverage for a low cost, protecting your family without you having to fund the insurance company's investment portfolio. Insurance companies aren't evil. They're just incredibly smart businesses. They use your premiums to generate massive investment profits, all while carefully controlling their risk and their claim payouts. But now you understand their strategy. With this knowledge, you can make smarter decisions to protect both your family and your wallet. If you found this video helpful, please hit that like button so more people can learn the truth about their insurance. Subscribe for more simple finance and insurance breakdowns, and let me know in the comments, what insurance topic should I explain next? Thanks for watching.